Okie dokie, so in this video, we will be discussing on how to go about using candlestick patterns during volatility contraction. So what is volatility contraction, right? Here's the thing. The market moves from a period of low volatility to high volatility and vice versa. If you don't believe me, just look at your charts, right? Notice that, the range of the market, the volatility is never constant. It always, breaks out and you have huge volatility and then the thing kind of dies out, gets a little slow, candle starts to contract and then it breaks out once again. So this typically how the market cycle move from a period of low volatility to high volatility. So when you are trading, right, ideally you want to be entering during a period of low volatility. Why is that? Number one is that your stop loss is usually tighter during a period of low volatility, right? If you think about it, it makes sense, right? Because as the market, the volatility contract, the range gets smaller and you can actually just reference this range to set your stop loss. Or alternatively, if you were to use a tool like the average true range indicator to set your stop loss, the ATR value tends to be relatively low during low volatility period, right? So the benefit of having a tighter stop loss is that you can put on a larger position size and still keep your risk constant. Does it make sense? So a smaller stop loss allows you to increase your position size and still keep your risk constant. So let's say, for example, each trade you put on, you're risking, let's say $100. Okay, so mathematically, right, if your risk per trade is always $100, then it's simply a function of your stop loss and your position size. If you have a tighter stop loss, you can put on a larger position size and still keep your risk constant. However, if your stop loss is larger, right, then your position size must be reduced and keep your risk constant at $100. So this is an equation that I'm sure most of you are familiar with. If you're not, then this equation holds no matter what, right? So if you want to have tighter stop loss, it allows you to get away with a larger position size and still keep your risk constant. The second benefit to this is that when you enter your trade with a larger position size, right, it gives you a more favorable risk to reward. Why is that? Because you know that the market moves from a period of low volatility to high volatility. So if the market goes in your favor and volatility expands, you can see that your R multiple on the trade can really, rake up pretty quickly. Okay, so in terms of a risk to reward, entering your trades during low volatility period, right, would, give you a more favorable R multiple as the outcome of your trade. Okay, so these are two reasons why, I like trading during a low volatility period, because you can enter your trade with a relatively tight stop loss and put on a larger position size. And if it does break out, right, the risk to reward is usually quite favorable. So with that said, let me share with you a couple of examples of trading volatility contraction. So this one over here is sugar, right? The sugar futures. And again, I'm just going to share with you generally what's going on this chart is that the trend is towards the downside. Okay, and you can see that this market traded lower, came into this swing low or area of support, and then volatility contracted. How do I know that? Well, just look at this candle. Look at the range of the candle. It got smaller and smaller until it finally broke down. Right? So all you need to do is compare the size or the range of the candle. If it's getting smaller, it's telling you that volatility has contracted. And chances are when it breaks out, it will tend to expand again. Okay? So similarly, right, this portion over here, volatility expanded, then over here it contracted, and over here it contracted. Just look at the range of the candlestick pattern. You would have a good clue to, to the volatility of the market. With that said, right, I just want to share with you a few pointers when you are, looking to trade this type of breakouts. Number one, have the trending move, right, in your trade in the direction of the trending move. What is a trending move? Trending move is basically the stronger leg of a trend. Like this one over here is the trending move. This is the trending move. This is a trending move, right? Trade in this direction of the trending move. In other words, trade with the trend. And second thing, right, the volatility contraction, the VC, right, you want to see, small as possible, because, when it does, break out, you can expect the volatility to expand and pick up. right? So these are a couple of things to take note of. Another example, you can see over here, strong trending move. Then what happened? Volatility contraction. You get somewhat like a descending triangle. Volatility expands when it broke down, and then volatility contracted again. Okay, again, this one over here, price traded lower, volatility contracted, then it expand a little bit before it starts to get choppy, and it done volatility contraction, then expand and reverse. So you can see, right, this phenomenon pretty much happens all the time in different markets. So how you want to go about trading it is that for me personally, I like to look to trade the breakout of this tight volatility ranges. Okay, and stop loss is just usually reference it from the swing high or swing low. So let's say, for example, if price breaks down of this low, I'll set it one time the average true range above this high, maybe say somewhere over here. So these are generally how I go about trading volatility contraction. As I've said, right, I think this is a clear example that this isn't a trading strategy by in itself. Candlestick pattern, they are useful to serve as entry trigger. But when it comes to stop loss, when it comes to trade management, risk management, you can see that candlestick patterns are not able to help you answer or manage all these scenarios. Okay, so I hope this kind of share with you some light on how to go about trading candlestick patterns using volatility contraction. So with that, let's do a quick recap, right? Number one, the market moves from a period of low volatility to high volatility, right? You can see that the word volatility, if you try to pronounce it too many times, right, your tongue will get tight, right? That's what is happening to me right now. Okay, low vol to high vol period. And you tend to want to enter your trades during low volatility period because it gives you a favorable risk to reward on your trades, and your stop loss tend to be tighter. And with a tighter stop loss, you can put on a larger position size relative to your risk. Okay, so with that said, right, I have basically come to the end of this video, and I hope this candlestick trading course really gives you a good foundation on how to go about trading candlestick patterns. Now, if you still want to learn more, right, again, go down to my website tradingwithrainer.com. I'll put the link below, and download this ultimate guide to price action trading. As I've said, right, a few times, it would complement whatever you've learned in this candlestick trading course. And on top of it, right, if you want to learn more about trading, go and get this ultimate trend following guide as well. This is nothing to do with candlestick, but it basically teaches you about the trend following methodology and how you can go about riding massive trends in the market, so you can grow your wealth steadily over time, right, even during a recession. So these two guides are completely free. Just go down to my website tradingwithrainer.com and get your hands on it. So with that said, I wish you good luck and good trading. If there's anything, right, just leave a comment below and I'll get right back to you. And if you have enjoyed this training series, right, hit the like button, hit the subscribe button, as I would really appreciate it. So with that, I wish you good luck, good trading. Talk to you soon.